Well, stocks continue their march higher in the wake of U.S. CPI data and their benign confirmation with the PPI report today. But the markets are strangely of two minds about what comes next. And we're going to try to unpack why that is and what might tilt them one way or another, even as we look down the barrel of a Fed policy announcement in the middle of next week. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And today we are going to get a little bit of a gut check with what the markets are doing here and where positioning stands. And then move on to have a look at the economic data, last bit of it left for the end of the week, that should tell us a little bit more about where sentiment and, most importantly, where recession risk resides. So let's consider first where markets find themselves, and I'm looking at the S&P 500 here just as a barometer of overall risk appetite. We can see here over the past 2 days a spirited rally back to retest the spot where markets initially started to break down at the beginning of September. So just to quickly do a bit of history here, this was the top in July, where Federal Reserve Chair Jerome Powell famously appeared in Congress and told them that rate cuts were now an imminent sort of thing and not something abstractly on the horizon. That spooked markets because that clearly marked something of a concern about growth. The markets did not interpret news of incoming rate cuts as a good thing, certainly not the urgency with which the Fed was talking about them, but instead said, oh, well, it looks like the Fed has recognized some kind of a growth concern. That gave us an ugly crescendo at the start of August. There was a subsequent correction higher as the panic ebbed, a bit of economic data signaling that perhaps it's not quite the time to set your head on fire. That helped along here. And as we look then where September starts, it's right around this range here above the 5,600 figure. We crack through it at the beginning of September, and we've now come back to retest this very area. So we don't have a bullish setup here, as it were. We're still having to contend with a series of lower highs, and we're still sitting at the underside of where a bearish breakdown has occurred, retesting it, former bounds of the range floor getting scratched at from the underside here. And of course, if this holds, the breakdown remains valid, and perhaps we get a lower high that forms. But nevertheless, the market's showing a lot of vigor, and vigor for encouraging reasons if upside follow-through is to be expected. Notice this long wick right here on yesterday's candle and then a subsequent rally. That reflects this seesaw in the wake of U.S. CPI data. Here's where the data comes out. Markets initially sell off, then rip higher. That's the wick. That's the subsequent higher close that you see right there. We get a little bit more in the realm of numbers today. U.S. PPI numbers, the producer price index, wholesale inflation, as it were, that comes out, as does the weekly jobless claims report. And so we can see here that the markets jostle around a bit as those things come out. There's a sort of slow, quiet consolidation from yesterday's closing highs. A little bit more data, so things get a little bit more jittery, but ultimately the markets don't go anywhere and resolve for another leg upward. What was it in this data then, is the natural question. that gives us this dynamic? Well, consider what came out. The headline inflation number, a little bit softer than expected, but not by much. 2.6 expected, 2.5 on the realized result. And the month-on-month numbers exactly on the screws. The core number, steady at the year-on-year, and just a touch warmer at the month-on-month reading, 0.3% added to core inflation versus 0.2 expected. The PPI numbers, likewise, non-controversial. The core numbers a little bit lighter, 2.4 versus 2.5 expected. The headline also a little bit lighter, 1.7 versus 1.8 expected. The monthly numbers a little bit warmer, but again, no big controversial figures here. And indeed, the July numbers here revised a little bit higher for the headline from the negative number, revised a little bit lower to a negative 0.2% from the core's reading. But of course, this time around, that number beats a little bit relative to forecasts, much as we saw for CPI. So the key takeaway here seems to be, especially with CPI, and of course with PPI to follow, but especially with CPI, which is of course the heavier duty release, the one imbued with more speculative fervor, and the one coming a day earlier and setting the stage. The mood there seems clearly to be there is not so much of a growth scare now that demand is so weak that prices are collapsing, that prices are falling much faster than expected. And so perhaps there is no urgency here for the Fed to cut by 50 basis points, which has been a key object of speculation, needless to say. And they could move forward with a smaller cut of 25 basis points, and that will be okay. That will not substantially upset the apple cart as far as economic growth is concerned. And we can see the way that these things have evolved. So a month ago, we're looking at almost a 50-50 chance between a 25 basis point cut and a 50 basis point cut. Not surprisingly, that's of course immediately in the wake of August's volatility. A week ago, even, it's more like 60-40. But yesterday, in the wake of that CPI number, over 80% chance that we are going to get the 25 basis point cut, less than a 20% chance that it's going to be the larger 50 basis point version, and of course, this is what the markets do. Now, when the numbers initially come in as expected, there is this negative reaction, and that echoes what happened with the jobs report last week, with ISM data last week, because as we can see, last week there is still meaningful ambiguity. 60-40 still puts a very significant chance around a 50 basis point cut, which basically means there is an almost coin toss of a chance that the Fed will have to admit that they missed the boat in July, and now they have to scramble and cut double the usual 25 basis point amount because they feel themselves lagging some sort of urgent growth concern. When the markets get the CPI numbers, that initially seems to be a level of thinking where they go, well, these numbers don't really move the needle. They're almost exactly as expected, much as it was in broad terms with the jobs report, with the ISM numbers, and that doesn't give us any more clarity on whether the Fed is behind the ball or on pace with it. And so initially the markets get disappointed. Ostensibly, they would have much preferred a slightly warmer CPI number or a significantly weaker one, either locking in the 50 basis points or showing with unmistakable clarity that such a drastic move isn't necessary. That isn't what they get, but ostensibly they get enough of it. At least things are not breaking down, you might say. There is no crazy decline in demand being signaled by a dramatic discount in price growth. And so the markets take heart, they rally. Hence, we get locked in at over 80% for the smaller cut, and stocks go up. And then today, things start to get a little bit rickety. We've come back down again, and we're once more close to a 60-40 split. So the markets are once again toying with the idea that the Fed is maybe 30% or more likely to go with a jumbo double-sized cut. And that really speaks to the way that overall policy expectations have evolved here. Notice, since this panic low in August, where the markets really hit a fever pitch of recession worry in the wake of a very disappointing jobs report, a soggy CPI report for that period, and start to think that things are really starting to get untoward in a very near-term way. Once the data starts to allay those fears and suggest, yes, things are getting soggy, but it's not like things are falling apart immediately, you get the sense that the outlook for this year, that's in the gray here, as implied in Fed funds futures, that starts to anchor. But what you don't lose is the perspective that the Fed might well be too late. And the way you can see that here is in the evolution of rate cut odds for next year and the sum. Next year here in the yellow, that's 20 to 25 right there. The sum of the two, that is the overall size of the rate cut cycle from now through the end of next year, is the orange line. And you can see that even as the markets bounce, the outlook is growing more dovish. That is to say, when you look at what the markets see this year versus next year, they are saying, for all of their standing still this year, the Fed will have to do more next year. Notice, of course, this is exactly the same logic that prevailed from mid-April until the Fed finally started to signal imminent rate cuts at the beginning of July, and why that signaling ultimately didn't sit well with stock markets. Consider how U.S. economic data has behaved. Since mid-April, right where that last move we just looked at starts, U.S. economic data has been deteriorating relative to forecasts, suggesting the U.S. economy is weakening. At that time, the market said, the Fed doesn't want to cut. You can see the gray area fairly steady here. This is the Fed resisting rate cuts, and as of June, slashing its 2024 rate cut outlook from from 3 cuts rather to 1. As this holds steady, the markets go, yeah, but the economy is slowing because the data is deteriorating, at least relative to expectations, which means the Fed's worldview is stale. They are going to find themselves behind the ball and will need to do more easing next year. So as this holds, this builds out for 2025. So when the Fed finally says it's go time, the markets don't take that as good news. They take it as, the Fed has recognized the economic weakness we've been looking at. A similar dynamic seems to be occurring here. Things are steady now because the panic here clearly has not metastasized into something larger, and that has locked in a 25 basis point cut as more likely, That much seems clear. But the markets still are worried that the Fed is way too slow and way too timid. We can look at this by the numbers. Consider, at the bottom of the panic, the market saw 100 basis points being baked in for this year, 104. That has come down to 86. So we have less of a likelihood of 4 cuts. 3 are still baked in. Ostensibly, that means September, October, December, or some combination thereof. If one of them is a 50 basis point cut, the Fed might skip a move, or we might be leaning back toward 100 basis points. But the overall story has become a little bit less dovish to the tune of 18 basis points relative to the last time that recession worries were at their highest. Now consider what's going on for 2025. They also had 100 or so basis points baked in for next year when the panic was at its crescendo. That's only become bigger, which is why this sum has become more dovish. Now the markets see 141 basis points in easing next year, which is to say, while 2024 became 18 basis points less dovish, 2025 became 36 basis points more dovish, implying a 2-to-1 exchange rate between rate cuts missed or taken off the board this year and added next year, implying the Fed is going to be late and they're going to have to scramble and cut more because they are dragging their feet now. That, of course, suggests they are missing some kind of an economic downturn that they're not responding to with enough attention and raises growth concerns. Not surprisingly, we have not allayed those even by overtaking September's high on the S&P 500, never mind July. And this is where consumer confidence comes in. The next big piece of economic data for us to contend with will be the University of Michigan's Consumer Confidence Survey. This is the last real bit of notable news flow for the weekend, the last high-profile indicator before we get into the gravitational pull of the Fed policy announcement next week. Now, this is an interesting indicator because it has really pinned down exactly what the Fed has been looking at and what the real trends have been that the Fed needs to be responding to, all the way back to 2021. Notice here, as inflation expectations build, in the gray bars here is the one-year inflation outlook polled from consumers in this survey. As these inflation expectations build, sentiment is collapsing. Obviously a meaningful risk to economic growth, since almost all U.S. economic growth is driven by household consumption. Anywhere between 75 and 80% contribution to GDP comes from household consumption. So if consumers are getting gloomy because inflation expectations are rising, obviously that's not good news for their propensity to consume and thereby for growth. The inflation outlook peaks, shock of shocks, when the Fed starts raising rates in March of the subsequent year, 2022. As those cuts begin to happen, sentiment bottoms and starts to improve. And as inflation expectations march lower, sentiment marches higher. This says that what consumers really worry about is the cost of living and prices. And were that not to be an issue, everything would be okay. And as this improves, so too does their disposition. Until you arrive in June. June marks a peak. You can see here there's a slight welling up of inflation here going into the mid-year. Same dynamics hold. Sentiment cools as inflation expectations rise. But notice what happens thereafter. Inflation expectations fall back down. They lose a hold on 3%. They are sliding back to the lowest we've seen them in over 3 years. And sentiment isn't improving as it was when inflation expectations fell here, or here, or indeed here. No, sentiment remains downbeat. And if we look at the expectations here for this incoming release, we don't expect major changes, but that we've seen this trend now for 3 and perhaps going on 4 months is eye-catching, because it signals that consumers are afraid of more than just inflation. That this happens from June into July is, of course, extremely telling, because this is precisely the time, as we have just seen, where the Fed begins to loudly worry about the labor market, which, of course, is where it begins to say that rate cuts are now something coming in the immediate future, not some abstract, distant one. So, when this data comes out here, the key question will be, are consumers worried about growth? Because if they're not cheered by lower inflation, well, they're worried about their jobs and they're worried about the broader economy. And lower inflation isn't enough of a tailwind. This, of course, rhymes precisely with the Fed essentially saying most recently that the reason cuts are coming is because a situation where unemployment is too high has become about on par of a risk with inflation being too high. Now, going back to this chart here, we can see that U.S. economic data still is very much tending to disappoint relative to forecasts. This economic surprise index sitting below 0 suggests that at least the scope of negative surprise has been a little bit steady recently, but the tendency to disappoint remains. So this might actually give us a weaker set of numbers yet. And it will be this interplay between inflation expectations and what sentiment does that will be particularly eye-catching. If consumers, through this survey, signal to stock markets, we're concerned about recession, and lower inflation will not get us into a more bright mood, well, then that very logic the markets have been operating on, whereby the Fed's foot dragging will miss the boat on landing the economy softly from its inflationary spike, and some sort of economic downturn, if not outright recession, is now on the horizon, follow through on this upside momentum might well prove difficult and essentially act as a wall, holding Wall Street right about here or someplace nearby until we get into the Fed next week. If then the Fed continues to signal a more gradualist approach, that we are going to get one cut is seemingly more likely than not, but that, of course, shifts the focus to what the Fed says about next steps, what it forecasts for growth, what it forecasts for the labor market, and the rhetoric with which it delivers the message. If it sounds like we still have consumers worried about recession and getting defensive, even as we continue to think the Fed might be too slow to react, stock markets might find themselves right back on the defensive. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things might progress thereafter. I'm back on with Chris tomorrow, as I am every Friday, for Futures Power Hour, on with Victor and Tom for First Call, back with Victor for the Price of Truth on Wednesday, writing for the news and insights portion of tastylive.com, and mouthing off sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back next week. Futures Power Hours tomorrow. Good luck trading. Thanks for watching.